Preparing for a financial analyst at E.ON interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at E.ON? I want to join E.ON because the company combines rigorous financial management with a purpose that matters: building a more sustainable energy system. The analyst role appeals to me because it connects detailed reporting, forecasting, and business partnering with decisions on networks, renewables, and customer solutions. I would bring strong Excel, accounting, and communication skills while developing deeper sector knowledge. E.ON's scale and transformation agenda would give my analysis meaningful commercial impact. While answering, connect your analytical skills to E.ON's energy networks, customer solutions, and energy transition strategy. Demonstrate commercial awareness, motivation for the company, and how your experience supports accurate, decision-useful analysis. Question 2. What do you know about E.ON's business model? E.ON is a major European energy company focused primarily on energy networks and customer solutions. Networks provide regulated infrastructure and relatively visible returns, while customer solutions include supplying energy and delivering solutions such as electrification, heating, and efficiency services. The model is capital-intensive, so investment discipline, regulation, financing, and cash flow generation matter greatly. I would analyze both financial results and operating indicators because customer volumes, connection growth, and regulatory outcomes influence performance. Make sure to cover E.ON's focus on energy networks and customer solutions, regulated and competitive activities, recurring cash flows, capital investment, energy transition exposure, and the importance of operational and regulatory drivers. Question 3. Walk me through the 3 financial statements and how they connect. The income statement shows revenue, expenses, and profit over a period. Net income flows into retained earnings on the balance sheet, while the cash flow statement reconciles profit to changes in cash. Depreciation reduces accounting profit without using cash, so it is added back in operating cash flow. Capital expenditure reduces cash and increases property, plant, and equipment, while financing activities capture debt and equity movements. I always check that the balance sheet balances and cash reconciles. In your answer, explain the income statement, balance sheet, and cash flow statement. Show how profit affects equity, non-cash items reconcile to cash, and balance sheet movements explain operating and investing cash flows. Question 4. How would you build a monthly forecast for an E.ON business unit? I would begin with the latest actuals, understand the unit's revenue and cost drivers, and separate recurring items from exceptional effects. For an energy business, I would model customer numbers, consumption, prices, weather, network volumes, headcount, procurement costs, and planned investment. I would discuss assumptions with operational managers, create base, upside, and downside cases, and document ownership. After submission, I would compare actuals with forecast, explain variances, and update assumptions rather than simply override outcomes. Be sure to mention historical trends, operational drivers, seasonality, price and volume assumptions, regulatory factors, cost categories, scenario analysis, stakeholder validation, and variance monitoring after forecast submission. Question 5. What is the difference between budgeting, forecasting, and long-range planning? A budget is usually an agreed annual plan used to allocate resources, set targets, and measure performance. A forecast is a current estimate of what will happen, updated as market conditions and operating assumptions change. Long-range planning looks further ahead, often linking strategy, capital investment, regulation, financing, and portfolio choices. At E.ON, I would avoid treating the budget as a fixed prediction. I would use rolling forecasts to provide management with the most realistic outlook. Focus on purpose, timing, flexibility, and level of detail. Budgets establish targets and resource limits, forecasts update expectations, and long-range plans assess strategic direction, investment needs, financing, and value creation. Question 6. How would you investigate a significant unfavorable variance in EBITDA? I would first quantify the variance and compare it with both budget and prior year. Then I would decompose it into price, volume, mix, timing, foreign exchange, one-off items, and underlying cost movements. For an E.ON unit, I would investigate energy procurement, customer demand, network performance, regulatory effects, and operating expenses. I would validate the ledger detail with business owners, distinguish temporary from structural issues, and present management with an explanation, revised outlook, and practical actions. Mention quantifying the variance, decomposing price, volume, mix, timing, foreign exchange, and cost effects, validating accounting treatment, speaking with owners, identifying root cause, and recommending corrective action. Question 7. How would rising interest rates affect E.ON's financial performance? Higher interest rates can increase borrowing and refinancing costs, reduce project valuations through higher discount rates, and make capital-intensive investments less attractive. The impact depends on debt maturity, fixed versus floating exposure, hedging, and regulatory recovery mechanisms. For networks, allowed returns may eventually reflect financing conditions, but timing matters. I would assess sensitivity by business unit, review liquidity and refinancing schedules, and test whether investment returns remain acceptable under higher funding costs. In your answer, cover floating rate debt, refinancing costs, discount rates, regulated returns, project economics, valuation, customer affordability, hedging, and potential offsets from stronger allowed returns or disciplined capital allocation. Question 8. What financial KPIs would you monitor for E.ON? I would monitor adjusted EBIT or EBITDA, operating cash flow, free cash flow, net debt, leverage, capital expenditure, and return on capital employed. I would pair those with operational measures such as customer numbers, energy volumes, connection growth, service reliability, churn, and project delivery. The right KPI set depends on the business. Networks require regulatory and reliability indicators, while customer solutions need margin, retention, and growth metrics. I would focus on trends, drivers, and target performance, not isolated figures. Be sure to distinguish group and business unit metrics, including EBITDA, adjusted EBIT, operating cash flow, net debt, leverage, return on capital employed, CapEx, customer growth, network performance, and regulatory or sustainability indicators. Question 9. Explain working capital and its importance in an energy company. Working capital measures short-term operating assets and liabilities, typically receivables, inventory, payables, accruals, and customer-related balances. In energy, volatility can be significant because commodity prices, weather, billing cycles, collateral requirements, and seasonal demand affect cash timing. A rise in receivables or inventory consumes cash, while higher payables can provide temporary funding. I would monitor aging, collection performance, supplier terms, and unusual movements, then distinguish genuine operational improvement from timing effects. Cover receivables, payables, inventory, accrued costs, customer prepayments, collateral, seasonality, commodity price movements, cash conversion, and how working capital management can affect liquidity without changing reported profit immediately. Question 10. How would you assess whether an energy infrastructure project creates value? I would forecast project cash flows, including construction spending, operating costs, revenues or regulated returns, taxes, working capital, decommissioning, and financing assumptions. I would calculate NPV using a risk-appropriate discount rate and review IRR, payback, and value per invested capital. Sensitivities should test CapEx overruns, delays, inflation, rates, demand, regulation, and energy prices. I would also consider strategic benefits, resilience, and optionality, while ensuring those qualitative factors do not conceal weak underlying economics. Mention cash flow forecasting, CapEx, operating costs, useful life, regulation, taxes, financing, terminal assumptions, NPV, IRR, payback, sensitivities, scenarios, and strategic benefits that may not appear fully in headline returns. Question 11. What is NPV, and why is it useful for capital allocation? Net present value is the present value of expected future cash inflows and outflows, discounted at a rate reflecting timing and risk. A positive NPV indicates that a project is expected to create value above the required return. It is useful because it compares investments with different timing and scale on a common value basis. However, I would challenge the forecast, discount rate, and terminal assumptions and supplement NPV with sensitivities, scenario analysis, and strategic considerations. Explain discounted future cash flows, time value of money, risk-adjusted discount rates, value creation above invested capital, and limitations such as forecast uncertainty, terminal assumptions, and incomparable strategic benefits. Question 12. How would you value a regulated network business? I would start by understanding the regulatory framework, especially the regulatory asset base, allowed return, depreciation, inflation treatment, operating cost allowances, and investment recovery. I would project the asset base and regulated revenue over the relevant periods, then model cash flows, taxes, financing, and regulatory resets. Evaluation could use discounted cash flow or a regulated asset-based approach, cross-checked against comparable companies. I would pay close attention to regulatory lag, execution risk, and the sustainability of allowed returns. Focus on regulatory asset base, allowed return, depreciation, operating expenditure, inflation, investment plans, regulatory resets, financing assumptions, cash flows, and the difference between accounting earnings and regulated economics. Question 13. How do International Financial Reporting Standards accounting standards affect analysis of E.ON's results? International Financial Reporting Standards provides the reporting framework, but several areas require judgment and can materially affect analysis. I would pay attention to impairment testing, leases, provisions, financial instruments, revenue recognition, and presentation of exceptional or adjusted items. I would reconcile statutory figures with management measures and understand whether adjustments are genuinely non-recurring. For an energy company, asset lives, commodity contracts, regulatory balances, and decommissioning obligations can be important. Good analysis means understanding both the reported number and the economic driver behind it. Mention consistency, judgment, comparability, impairment, leases, provisions, financial instruments, revenue recognition, presentation of adjusted measures, and reconciling statutory results with management performance indicators. Question 14. What is the difference between EBITDA and operating cash flow? EBITDA is an operating earnings measure before interest, tax, depreciation, and amortization. It can help compare operating performance, but it is not cash flow because it excludes working capital movements, cash taxes, provisions, and other operating items. Operating cash flow reflects the cash generated by operations after those effects. In a capital-intensive utility, I would never use EBITDA alone to judge financial strength. I would pair it with operating cash flow, capital expenditure, debt, and cash conversion. Explain EBITDA as an earnings measure before interest, tax, depreciation, and amortization. Contrast it with cash generated after working capital movements and other operating cash items, noting limitations of both metrics. Question 15. How would you analyze E.ON's capital expenditure and investment pipeline? I would split CapEx into maintenance, regulatory, growth, and strategic transformation spending. For each project, I would review approved budget, committed costs, schedule, expected returns, regulatory recovery, financing, and key delivery risks. I would compare actual spend with physical progress, because underspending may indicate delay rather than efficiency. I would also track benefits after completion, such as connections, reliability, margins, or cost savings, to test whether the original investment case is being realized. Cover maintenance versus growth CapEx, project approval gates, committed versus discretionary spend, timing, returns, regulatory recovery, execution risk, cash funding, and post-investment benefits tracking. Question 16. Describe a financial model you have built or improved. I built a rolling forecast model that linked customer volumes, pricing, headcount, operating costs, CapEx, and cash flow. I separated inputs, calculations, and outputs, added data validation checks, and included base, upside, and downside scenarios. Previously, the team relied on manual spreadsheet consolidation, so I standardized assumptions and automated recurring imports. The process became faster and more transparent, and managers could see which operational drivers changed the forecast. I documented the model so another analyst could review and maintain it. Be sure to explain the model's purpose, structure, assumptions, data sources, checks, scenario functionality, stakeholder use, improvement achieved, and how you protected against errors and unsupported assumptions. Question 17. Which Excel functions and tools do you use most in financial analysis? I commonly use SUMIFs, XLOOKUP, index match, if logic, date functions, pivot tables, and conditional formatting. For recurring reporting, I use Power Query where appropriate to clean and combine source data. I structure workbooks with clear input, calculation, and output sections, minimize hardcoding, and include checks for totals, missing data, and balance sheet integrity. I use charts to highlight trends and drivers, not decorate reports. The key is applying tools reliably to answer a business question. Mention SUMIFs, XLOOKUP or index match, if logic, date functions, pivot tables, Power Query, charts, scenario tools, error checks, and disciplined spreadsheet design rather than listing functions without business context. Question 18. How would you ensure the accuracy of a management report? I would reconcile source data to the general ledger or approved reporting system, check period, entity, currency, and sign conventions, and compare totals with prior submissions. I would investigate unusual movements using both analytical review and supporting detail. Before distribution, I would verify formulas, refresh dates, version control, and that narrative commentary agrees with the numbers. A second-person review is valuable for material outputs. I would retain clear documentation so the report is reproducible and audit-ready. Focus on source reconciliation, control totals, period and entity checks, reasonableness analysis, version control, review segregation, documented assumptions, exception follow-up, and confirming that commentary matches the underlying numbers. Question 19. Tell me about a time you explained complex financial information to a non-finance stakeholder. In a previous role, an operations manager challenged an unfavorable cost variance because the underlying activity had not changed. I translated the analysis into 3 drivers: supplier price increases, timing of invoices, and one exceptional repair. Instead of presenting accounting terminology, I showed the cash and forecast impact on a simple bridge. The manager confirmed the operational explanation, corrected one coding issue, and agreed a procurement action. That experience reinforced that effective analysis must lead to understanding and action. Use a concise star structure, describe the audience, simplify technical detail, connect numbers to operational consequences, confirm understanding, and show the decision or action enabled by your communication. Question 20. Describe a time you found an error in financial data. During a monthly review, I noticed that one business unit's margin had increased sharply despite stable volumes. I traced the movement to a duplicated revenue upload caused by an incorrect file range. I confirmed the issue against the source system, quantified the reporting impact, and informed my manager before the report was issued. We corrected the entry and added a record count and duplicate value check to the process. The result was accurate reporting and a stronger preventive control. Highlight skepticism, reconciliation, root cause analysis, materiality assessment, escalation, correction, control improvement, and a calm, non-blaming approach that protects reporting quality and stakeholder relationships. Question 21. How do you prioritize competing deadlines during month-end? I start by mapping fixed deadlines, dependencies, and material deliverables, then prioritize tasks that affect consolidated reporting or other teams' work. I create a short checklist, block time for reconciliations and review, and communicate early if a dependency may slip. Routine tasks can be standardized or automated, while judgmental items receive focused attention. I do not sacrifice key controls for speed. Instead, I escalate trade-offs clearly and ensure every material figure has an explainable source. Mention materiality, dependencies, fixed reporting cutoffs, stakeholder expectations, task planning, early escalation, quality controls, delegation where possible, and protecting accuracy under time pressure. Question 22. What would you do if an operational manager disagreed with your forecast? I would first understand which assumption the manager disputed and why, rather than defending my model immediately. I would compare the view with historical data, current operational evidence, contracts, and market information. If both perspectives were plausible, I would present scenarios and show the financial impact of each. We would agree the most supportable base case, document the assumption and owner, and retain a downside case. Escalation would be appropriate only if material differences remained unresolved. Explain how you would listen, test assumptions against evidence, distinguish commercial judgment from data error, use scenarios, agree ownership, document differences, and escalate only when alignment cannot be reached. Question 23. How could energy prices and weather affect E.ON's forecast? Energy prices and weather can affect demand, procurement costs, customer margins, renewable generation, network volumes, and cash requirements. Cold weather may increase consumption, while unusual temperatures can distort comparisons with normal patterns. I would distinguish hedged from unhedged exposure, review contract pass-through mechanisms, and use weather-normalized analysis where possible. Rather than relying on one-point estimate, I would model scenarios for prices, volumes, and temperature, then explain which effects are external and which reflect operational performance. Cover demand sensitivity, procurement and selling prices, hedging, seasonality, temperature effects, renewable generation, network volumes, customer affordability, scenario ranges, and separating market effects from controllable performance. Question 24. What risks should a financial analyst consider when reviewing an energy business? I would consider regulatory changes, commodity price exposure, customer credit, liquidity, interest rates, foreign exchange, cyber threats, operational outages, project delays, climate effects, and accounting judgments. I would assess each risk by likelihood, financial impact, time horizon, and existing mitigation. For example, a network project may face construction and regulatory risks, while customer solutions may carry margin and credit risk. I would quantify sensitivities where possible, identify early warning indicators, and escalate material issues with proposed mitigations. Be sure to discuss regulatory, commodity, credit, liquidity, interest rate, foreign exchange, cyber, operational, project delivery, climate, and accounting risks, along with quantification, controls, and escalation procedures. Question 25. What questions would you ask the hiring manager at the end of an E.ON Financial Analyst interview? I would ask how success is measured during the first 6 and 12 months, which business decisions the team most needs to support, and where current forecasts or reporting processes could improve. I would also ask which systems and data sources the analyst uses, how finance partners with operational teams, and what development opportunities are available. Finally, I would be interested in the team's biggest analytical challenge as E.ON invests in networks and customer solutions. Those questions show curiosity and commercial focus. Ask thoughtful questions about success measures, business unit priorities, reporting and forecasting cycles, systems, stakeholder relationships, development opportunities, current analytical challenges, and how the team supports E.ON's strategic transformation. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.